Well, retail sales today surprised the markets and fell 0.4% in March. So just how does this affect the outlook for the global or the Australian economy? Gareth Aird is the Commonwealth Bank's Head of Australian Economics and joins me now. Gareth, many thanks for your time.
Hey, Ross.
I just want to go to the whole issue because we've got conflicting economic data out right now. Inflation is weaker than expected. Unemployment is much better than expected. And then all of a sudden these retail sales come out much worse than expected. So how do you sort of weigh all that stuff up?
Well, if we start by thinking about where the RBA's interest rate settings are at the moment, they're restrictive, which means they're weighing on economic growth and they're weighing in particular on consumer spending. And that's also been, consumers have also been impacted not just by higher rates, but they're handing over more to government in the form of the tax take through bracket creep. That is manifesting itself now in quite weak numbers related to retail and household consumption more broadly. And if you adjust for population growth and inflation, the volume of consumer spending is down about 2.5% through the year.
Okay, so what you're saying is the cost of living crisis. You can see now the interest rate rise are having an effect on a per capita basis.
Absolutely.
So why, therefore, is inflation not taking off? Why is the unemployment rate not starting to tick up as you would also expect at that time?
Look, we think the unemployment rate will tick up over time, and it is higher than when it hit a cyclical low of around 3.5%. It's up near 4% now. So we're kind of there or thereabouts in terms of seeing an uptrend in the unemployment rate, albeit we thought it would be a little bit higher than where it is right now. On the inflation side, though, it's really interesting. If you split up the inflation basket by discretionary and non-discretionary items, what you can actually see is discretionary inflation has collapsed.
Yes.
And that's picking up the weakness in consumer spending. Where inflation, though, is proving to be sticky is on the non-discretionary side. And a lot of that inflation is being driven, we think, by much stronger than anticipated population growth. That's putting big upward pressure on rents.
So someone's trying to suggest that it's about government spending as well, with the government potentially spending an extra $12 billion over the course of this financial year. Does that fuel it as well as the immigration?
Well, what's happened is because the population growth is so strong, the states have got to run these big infrastructure projects in order to dilute the public stock, if you like, of capital, and that's pushed up the cost of building a home. That's also part of CPI. So you've had strong growth in rents, you've got strong growth in the cost of building a home. Insurance prices have gone up a lot, in part because the cost of insuring a home is, the home is now worth more because the cost of replacing it if something happens has gone up. So you're getting movements upwards in prices for things that the RBA really cannot control. And for the items that they can, you've actually seen inflation come down quite swiftly in line with the weakening consumer.
So in your note today, you basically say that though you previously had 3 interest rate cuts this year, you've now changed that. That's a big call for an economist to make.
Look, it was, and we had to do it today. We did it off the back of the inflation data that came out last week. We thought the core number would come in around 0.8%. It came in at 1%. That's a little bit too strong to see interest rates being cut in the short run. So we've pushed out the timing of easing.
But is there any bias you sense towards raising interest rates, as some say, like Warren Hogan, who was here yesterday?
Yeah, look, the near-term risk is with a rate hike. The RBA will not be cutting rates in the near term because they've just had an inflation print that was a little bit stronger than they'd forecast. You could say the consumer's probably a little bit weaker than they have anticipated, but if they're going to do anything in the next 3-4 months, they'd be more likely to hike than cut. We think they won't actually hike. We see them on hold. And if we get through the next 6 months with an economy that's continuing to slow, a rate of inflation that we think will continue to come down, then we can be optimistic that at the back end of this year, we do actually start to see some easing because the RBA is probably going to have to take the cash rate down around 125 basis points from where it is right now to take it away from a restrictive setting to something that looks more like neutral.
And you say around 3.1% is where you think it might land in the longer term?
Yeah, look, it's hard to be precise on this.
I understand that.
But we're thinking that the neutral rate in Australia is around 2.5 to 3%. You've got to have a bit of a margin there. So an easing cycle that gets you down somewhere to around 3% looks about right. Particularly if we look at debt servicing, I mean, Australian households right now are spending more of their income to service mortgages than ever before. So that tells you how restrictive policy actually is.
But you still say 1 rate cut in November this year?
Yeah, that's our base case. That's right.
It's going to be fascinating to see exactly how that plays out. And of course, we should always remember, of course, that people having a job is a good thing, don't we? So that's another thing we've always got to keep in mind, Gareth.
Exactly right. And
that's it.
As the RBA said all along, they want to preserve as many gains in employment as possible.
That's great. Gareth Aird, many thanks for your time.
Cheers.